Shiba Jafari. I work at Raise Capital, which is a hedge fund that we launched in Hong Kong in November of last year. I am their technical strategist. It's a fairly small team, so about 8 people. We've got a macro guy, fundamental guy, and I'm just the technical cat around the house.
My name is Sigurdur Stephenson, and I work as a Chief Investment Officer and a Portfolio Manager with Landsbankin, the biggest bank in Reykjavik, Iceland.
My name is Geraldo McDowell. I'm a trader since 1994, and 1997 I started actually my program with this MTA.
Kristen Hetzer, and I have an office in Palos Verdes Estates in Southern California. I'm a portfolio manager and principal of my own firm, Royal Palms Capital.
My name is Robert Dombrower, and I am now a resident of Orlando, Florida. I am a portfolio manager and chief technical strategist at ICC Capital Management.
My name's Steven Suttmeyer. I work at Bank of America Merrill Lynch in the technical research department, and I've been doing that for the last 5 years.
Craig Johnson, work at Piper Jaffray as the technical market strategist.
My name's Kingsley Jones. I'm the Chief Investment Officer of Jevons Global, which is my own investment advisory based in Sydney. And we cover mainly global equities, and we use a range of different techniques to advise clients on that.
I run the morning meetings, so every morning I produce a little packet that goes through multi-asset classes. I look at commodities, major currencies, and then all the indices that we cover on our portfolio. So we look at, we kind of go through the markets, we look at the major pictures, major movements, major trends, and then throughout the day I'll also use technical analysis for our trading. So entry, exit, stop loss, risk management, and so forth. And risk management is absolutely essential for us.
Everything is driven off of fundamentals, because that's the reason why people trade the markets. But the technician using the charts gives you opportunities to time the market better than just using fundamental data. We've had 2 bear markets in equities, 2000 to 2002, 2007 to 2009. What technical analysis gives you is an exit strategy to preserve your capital. Through my role at Bank of America Merrill Lynch, I've discovered that a lot of people have gravitated towards technical analysis.
I use technical analysis all the time in my investment work. So I'm a portfolio manager of global portfolios. But then I also work in the domestic market, which is for the time being mostly a bond market, government bond market, and so it's a little bit more difficult to employ technical analysis there as we know it here in the States. But still, the basic principles we are using, learning in some way. I didn't know at that time what I needed to learn, but I later found out that it was indeed the definition of the trend of the market, the major trend.
First Asian crisis actually took me to shake me a little bit and put me into the right track actually to learn how to timing actually my entry points and exit points in the market. Since then I kept trading actually, and I started also to be an IB in Brazil for ex-MF Global Fisher. At the time was MF Financial, and I developed a good relationship introducing the electronic trading in Brazil. At that time there was only trading throughout the phone with the investment banks and also the proprietary funds.
We do, and in fact it's a big part of our offer to clients. So we use technical analysis mainly for judging sentiment in global markets and also as a timing tool. And it's particularly useful given the scope of our activity, because we're trying to cover a whole lot of stocks in a whole bunch of different countries, and technical analysis is ideal for that purpose.
First, you look at things from a macro standpoint. I mean, there's so many things to look at, and of course, when you're dealing with individual clients, their objectives and so forth. But when it everything, you boil it down, it comes down to supply and demand. And technical analysis is going to give you an idea of, within the framework of your macro analysis and your objectives and strategies, okay, you can drill down and find out what is going on here from a supply-demand relationship, and what is your risk, and what kind of risk management tools do you need to employ.
If you're a real trader and you're dealing with market movements, the fundamentals don't do that. I mean, come on. But the chartists do, and I'm not saying they're going to be always right or whatever, but they're at least watching the dynamics of the market, and there's no other subject that deals with supply and demand.
What's difficult to grasp, I think, is that we really have two very different schools of thought. In the fundamental world, fair value is equal to the present value of future discounted cash flows. Okay, that's fair value. As technicians, we have fair value also. Fair value is the Friday closing price. That's fair value. Now, markets change. Okay, the change in price in the fundamental world reflects all the changes and all the variables that go into that free discounted cash flow calculation. It becomes very complex. As technicians, for the most part, we're really concerned with none of that, because to us as a technician, change in price is equal to the volume of stock you're buying or selling divided by the amount of time that you want to accomplish that task. That's it. Change in price equals volume over time. It's just that simple.
People tend to say what to buy CFA, when to buy CMT. Okay, it's in general it's kind of like this, but it's always good to know the financials, to know the numbers in the deeper perspective, to make a correct evaluation of of the asset that you're buying. People think the technical analysis is a little bit, in terms of technical analysis, they think a little bit superficial.
Think about it this way. Typical PE equation, price over earnings. Fundamentalists spend all their time thinking about E, and they try to come back and say, how does this fit relative to P? Guess what? I start at the top, and I start with price, and then come back around and say, does this make sense? So it's really truly an integrated process between fundamentals and technicals. Got the same outcomes, same goals. Price is all that matters, and at the end of the day, we're all working on the same equation, and they are jointly compared together. Ralph Acampora would call this fusion analysis.
We technicians see things happening. Hopefully we get the direction correct, but assuming that we do, the next most important question is, why is it happening? And that's the fundamentals.
The institutional space, like a lot of places, that's been my background for about 15 years in institutional investment management. And technical analysis is still frowned on in a lot of those places. Yet on the other hand, there's been a strong growth of retail interest in the market, and indeed in Australia now we have a large privately managed, self-managed as it is, pension fund sector. That's actually the largest part. And so amongst those folks, you're starting to see a lot more interest in technical analysis. So it's growing over time, and that leads to, I think, a bit of tension in the press, the financial press, as to whether they should be talking about fundamentals or technicals, and trying to bring those two sides together in their dialogue with their readers.
I come from a quant background. Before I became a technical analyst, I worked specifically my entire 18-year career as a portfolio manager in quantitatively driven products. I became a technical analyst when I was sort of kicking the multi-factor model that we were using, and one of the factors was sort of technical in nature. And as I was doing the back testing, I started to realize that perhaps this factor was not as robust as it should be. We came to the conclusion that you need to run a separate technical overlay to your quant model in order to gauge the timing factor. As I looked at the model itself over long periods of time, I was a little put off by the timing factor. We tended to create signals with our modeling that would either be a little bit early or a little bit late. And if you know my clientele, which is a lot of unions, a lot of public clients, police, fire, pension plans, and you go before those boards, and you say, well, we're not beating the benchmark right now because we have strong conviction that the model is saying this and it's going to happen, it's going to happen. Well, a year later, if it doesn't happen, you're wrong. The technical overlay that I developed with the guys at Bloomberg was basically to have an extra input on whether or not those model signals were well timed with where the markets were trend-wise.
And I tell people, even if you don't like technical analysis, let's say you can't stand technical, you better understand it because the other guy is using it against you. So just for defensive reasons, you need to understand people are going to make a move because two moving averages crossed or a trend line is broken. And if you're not aware of that, I think it's to your detriment.
It's the best thing. I'm suspect because I'm passionate to the subject. But I strongly recommend, technical analysis only can enhance your view of the markets.